Robschild, no investment advice. Welcome to the show where we review the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Got a lot to talk about today, so let's dive right in. Today is Wednesday, March 5th, 2025. Today's episode begins with the same theme that I brought up yesterday, tariffs. All I have to say, I think there are bigger powers at play here. While the media can't stop talking about Trump tariffs and the drama going on between what he says and what other countries are saying, etc., etc. I'm seeing other bigger things moving around in markets that don't seem tariff related. An example of one of those headlines is from CNBC right here. Dow closes nearly 500 points higher. S&P 500 surges over 1% on hopes for Trump tariff concessions. One of the biggest reasons I have for saying that I think the media has it wrong here is that the 10-year break-even inflation rate, ever since we started worrying about these tariffs in the first place, the 10-year break-even inflation rate has just been going down lower and lower and lower and lower. If there was fear of tariffs and that affecting inflation, this would be going the other way. The markets are betting the opposite right now and have been through this whole discussion. Add to that, we're not seeing significant increases in the price of gold. We're not seeing significant increases on yields right now. Are tariffs a concern right now, or is this a false flag? Next agenda item for today, the ADP employment numbers came out today. The actual coming in about half of what the estimate was. At only 77,000. The estimate was 148,000 and the last was 186,000. TradingEconomics.com has a great walkthrough of the information and a chart. This is a great place to get this information. As you can see, the service producing sector, it says, added 36,000 jobs, led by leisure hospitality, 41,000, professional business, 27,000. These are all jobs being added, financial jobs, while job losses occurred in trade and transportation and utilities. You know, transportation is one of these really big leading indicators, by the way. When people are starting to see, hey, we're not transporting people as much. Well, because what do people use transport for? They use it to use money to go out and spend, and of course to go to work and make money. So if you're not making money and you're not spending money, the transportation sector slows down. I find this pretty notable. And then health and education, health also losing jobs, and information losing jobs. So some more, 42,000 due to construction and manufacturing and natural mining resources. Mining shed 2,000 jobs. But look at this chart here. You know, this is a notable spike to the downside. This was unexpected. The market was expecting to stay flat here for February, and instead we spiked down. Notably, we're not getting below some of the lowest readings that we've seen before. Like in July, we had only 36,000. And then back in March of 2023, we had negative, actually, 4,000. So this is not showing like negative and then deeper negative and deeper negative, not yet, but this is a spike to the downside and is very notable. Next item I want to bring up is crude oil. Wow. Also from tradingeconomics.com. This is the price of crude oil. I'm not using TradingView for this because there's this very good information here. The main contributor of oil really dropping a lot today was crude stockpiles surged by 3.6 million barrels, far exceeding expectations. So basically, we're using a lot less oil than what the market thought we were using. Combine that with the transportation sector loss in jobs. I mean, I still think this is it. If you saw my short earlier today, I was like, the cracks are like we're not just hearing them now. We're seeing them in the ice. And Mr. Market is in danger, is the way that I see it. Very notably, today's close for crude oil being basically at the same level, the all-time lows of the past 4 years. You know, sorry, I got to scroll down so you can see the timeline. So, I mean, we've been bumping This has been acting as a support line really since May of 2021. So this is like all-time lows of the past 4 years. Is this the final crack to the downside? We have yet to see. Next, I wanted to bring up the Skew index today. This chart is useless as a bar chart because the candles are there's no candles. It's open and close at the same. It just has one number for each count. So anyway, but point is that I brought this chart up recently. What this represents is how expensive put contracts are, basically, far out of the money. So basically, how much are people betting on the market collapsing? And funny enough, it really peaked right here. Let's scroll on a little bit. This was when I brought it up on the show around February 18th. We peaked around 183, and since then, this has actually been collapsing to the downside. People have been either selling their puts or just not buying as many puts. I believe it's on the S&P 500. Correct me if I'm wrong. But scrolling back throughout history, I just want to note that, where did this metric peak before the great financial crisis? Well, it happened actually, when Michael Burry was flipping out about things long before everybody else saw the things falling apart afterwards. It was March of 2006, so it acted as a precursor. But funny enough, when things were really falling apart through 2007, 2008, the Skew index was making lower lows here. And so I'm sort of seeing this as a pretty good contrarian indicator. As I've said before, you kind of have to kill all the bears before the market can allow itself to get bearish. And many bears have been killed with this big move down in the Skew index. And as this continues lower, it's just more evidence of more bears getting less bearish, I guess. I mean, obviously, too, they might be selling puts after already making money. When the market really goes down quickly, because it doesn't even have to get to your strike price. If it gets drastically closer to your strike price in a short amount of time, you can sell it, and so the selling pressure can lower the prices of those put contracts, putting the Skew index lower. So anyway, next item on today's agenda, China. Big chart pattern little thing happening today. More specifically, I'm talking about KWEB, the ETF that has Alibaba, JD, the types of companies like Amazon, Facebook, etc. The Chinese versions of it. I've been talking about this bull flag for a while. It's pretty darn clear that we broke out to the upside. This is looking enormously bullish right now in Chinese equities. Again, how can you be so bearish on American equities and bullish on Chinese equities at the same time? It's reversion. It's the fact that the PE, the amount of money that these companies make, means the price should be much higher than it is, while the price of U.S. companies is way higher than it should be based on how much money the companies are actually making. This isn't rocket science here. This is reversion. This is going back to normal, a little bit of normalcy. The Chinese equity market has been held basically like a balloon underwater, and we're getting some floating to the surface, like I've been saying many times. Any which way you see this is a very bullish candle. So if you take this, the bottom of this bull flag here, and just drag it up, which would make it a parallel, connect it to the previous, even just the previous top of the wick of the highest high that we had in this run, and we're clearly broken far above it. So this, on every way that you look at it on a technical basis, this is looking very, very bullish to me. Does it have to do with the tariff talk, the tariff war? I don't know what's going on in tariffs, but I can see that this looks bullish and it's undervalued, and so I own a lot of it, and I'm excited about it continuing up until it gets to a normalish price of around $50 a share of that fund, specifically of KWEB. Moving on, 10-year 3-month is still obviously inverted. Although with the 10-year yield rising today a bit, we headed back up towards zero a bit today. Once this starts steepening above zero consistently, and it's not because, of the 10-year yield moving, but it's because the 3-month is going lower and lower, that's the capitulation. That's like that's like, okay, we're in recession time. We're here. We're in the storm. The waves are 100 foot high, and it's pouring rain, and the wind's 100 miles an hour in the storm. We're right next to the storm. We're not in it yet, but it's like it's here now. Is the way I see it. At least that's what my crystal ball says. Let's, maybe don't count our chickens before they hatch. Let's look out, also for the Friday's jobs report. This unemployment report could be huge. Again, with ADP numbers coming out incredibly weak, this indicates that there's a higher probability in my mind of the unemployment report showing further greater weakness than what the market has been expecting. No major changes in the daily reminders. Watch macro update 211.25 to hear me read through them. Although I adjusted the treasury yields, I had them as they were a month ago when this was updated to 11, and now they're between 4 and 4.6, still well above 3%. Once we get AA bonds to the 3% range, then the PE ratios of the S&P 500 at 30 might make a little bit more sense. But again, as it stands, there's still a big mismatch between the bond market and equities by itself. Besides all of the things screaming that a recession and all this stuff is going to happen. And then typically during the recession, you get the opposite. You get PE ratios shrinking to ridiculously low values, along with treasury bond and bond yields also collapsing, making the mismatch the other way. That's when you want to get out of bonds and obviously into as many stocks as you can get your hands on. Also, watch Portfolio Update 211.25 to hear me explain my crystal ball readings and my own portfolio. Moving on to the charts, the S&P 500. We had a bounce today of 1.12%, so looking more neutral than it did yesterday. I wouldn't count this as bullish, but I don't know what Mr. Market's going to do. Mr. Market's a crazy guy, and he can do anything. SMH, the Semiconductor Index ETF, getting a bounce as well. Just this chart pattern alone, does this look bullish to you? This does not look very bullish to me. It looks more like a dead cat bounce than anything. All this talk about, tariff worries are easing, and so the market's like going up. Like that's what the mainstream media is saying right now. It's unbelievable. This is not. There's no strength here. Not yet. Anyway, maybe it can develop into strength. It doesn't look like it's going to at this current moment. At best, maybe we'll be going neutral here a little bit. Also, the VIX, if, everything's calm now, everything's good, we'd see the VIX drop. Come on, at least below 20, closing at around 22 today. And again, does this look bearish to you? Not to me, not now, not yet. And the VIX future curve is still completely inverted over the next let's see here, 5 months, 6 months. It's above all of these contracts at the front end. So the market is still, the market's on fire. The market's on fire. That's what the VIX is saying. TLT still my favorite place to be. I wrote this to say that it looks like, we might be headed to a neutral zone, a fight zone, like Bollinger Band strategy. That's kind of what looks like what's going on here. What may end up developing is some sort of bull flag at the moment. That's what looks like may be developing, which is actually a bullish structure just like we had in KWeb. And obviously with oil collapsing today quite hard, yields pretty much always follow oil, and it's interesting having the 10-year note yield get a bid today, TLT dropping in price at the same time as oil just looking incredibly bearish here. I put out again my short video, I think when probably right at the bottom here, $65.28. And that level, funny enough, is the same, pretty much the same exact price, the low of today being 65.23, and this candle or previous intraday low let's see here, 65.26. So that's 23.26. So it actually dipped below this low here, and we haven't seen crude oil get that low since then, since May of 2023. Most chartists out there that I'm seeing everywhere, they're looking for 65. So they're looking to close below 65. So we haven't gotten there yet. Yeah, we cracked below the trend line that I had drawn, that I saw as being the support. And it's pretty good amount below it actually too. So just with my own technical analysis with this line, I mean, it already looks like it's over here, but I'm not going to depend on my lines. I'll depend on people that have been doing this for a longer time and know how this works better. They're saying $65 is really the level to watch. And we'll need a close below 65 and then like a close below that entire intraday candle to really like confirm that, yeah, we're heading down now to the 30 to 35 dollar a barrel oil price. Might as well look at the 10-year Treasury note yield. So when we look at this chart, yeah, like I'm saying, if anything, maybe we're going to neutral, or maybe this is just a dead cat bounce and we'll see it continue going down tomorrow. Friday, the jobs report is going to affect things. If unemployment's way higher, rates will drop like you wouldn't believe. Yeah, so Friday's a big day. The jobs report is a really big one. The dollar is continuing lower, and it's interesting the tariff talk. I was convinced. I have been buying into this idea that the tariffs. I mean, the tariffs are important for DXY, the value of the dollar, because this is a chart that measures the value of the dollar compared to other global currencies, and depending on taxes, tariffs, it directly affects this market. But with the threat of tariffs, a lot of times that actually means the dollar going higher, and so the dollar going down here, I don't really know what's going on with the dollar, but the dollar is looking very bearish at the moment. It's dropping pretty precipitously, and I will re-mention that during these three red candles, the S&P 500 has not exactly been just going up and up and up and up. Yeah, today it went up by a little bit along with the dollar dropping, which is normal, but we had the market dropping while the dollar was also dropping. So, let's see how this all works out. Just, a little bit of oddities going on. Dr. Copper with a PhD in economics popping 5%, very large green candle today. That's this one. Again, this is on UTC time. That's why I have the extra candle over here. So I don't know what Dr. Copper sees. I'm sure he's smarter than I am. This also may have to do with the tariffs. I don't know. With all this tariff stuff going on, there's some things that I'm not diving deep into. I suspect this has something to do with it, the copper market. I wanted to bring up gold again today just because, lower low, lower high. Are we developing a bearish pattern? That's what it looks like to me, to some degree. Another way to look at this is, hey, maybe this is a bull flag here, right? And then we're headed higher. We'll see. Last chart of today I want to share is junk bond credit spreads continuing to widen, now at 2.99%. This is going straight up now, and I don't know when it's going to end, but the bond market being smarter money, this is seeing more risk in lower quality credit, and this is what you see. Granted, we're still at historic tightness. We're still at that 3%, but if this continues to spread and spread and spread and spread, that's the market falling apart. So we got to keep a real close eye on it. Yeah, and that's it. That's all for today. That's all from me and my crystal ball. I hope you enjoyed. Thank you for watching. Stay safe out there, and see you next time. Robschild. One last thing I didn't mention. with oil dropping today, I bought some TLT calls, tiny little position, but you know, you get 100x leverage. I mean, why not? If you see the market falling apart and you think there's going to be a run to Treasury bonds, as I think may be happening over the next month. I got some calls on TLT that expire uh, midway through April, so a little bit more than a month. Pretty far out of the money, because yeah, I if this is when it's falling apart, I don't want to completely miss it. It's one of those situations where, you know, if you were right, you wish you had more in there, and if you're wrong, well, hopefully you didn't put too much in because you lost it all. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching again, and see you next time, Rob's Child.